recording of it, you'll be able to get it as soon as we finished. I'll upload it and send through the link on Telegram. Okay, guys. All right, so as I mentioned, today is a bit of an advanced session, so we're sort of restarting what we have been doing for the past couple of months. I think it's been about 3 months now since we started with the program. So if there's any time to actually join the advanced classes, then this is it. Now, what's important to note is that you need to make sure that when it comes to the beginning sessions, right? If this is confusing to you, then you should attend at least 1 or 2 of the sessions for the beginners, right? For all of this to actually make sense. If this is not making sense to you right now, I suggest that's what you do. There are videos. I even did a playlist on the YouTube channel where the guys who are starting out like brand new can actually go through and just watch all the beginner stuff, which I do hope will be very helpful. And yeah, from there we'll be able to move on through to the advanced sessions so we can sort of like keep up with the rest of the more experienced guys. Okay. Now, as customary, what we're going to be doing is, all right, guys, I'm just having a bit of an audio issue here today, so trying to fix this. I haven't used this mic in a while, so that's the reason why I didn't know it was working. It wasn't working well. But in any case, we're looking at the 3 basic elements, all right, 4. You can just say 4, just to say 4 basic elements that we usually look at. Now, if you've already downloaded the PDF with the strategies ebook, that's mainly what we're going to be focusing our attention on when it comes to the next couple of weeks. So it would be very beneficial to you if you just go through to the Telegram channel and just upload that to make sure that you'll be able to sort of like do that work or homework or reading up on everything that we're going to be discussing during the course of this session, and also just making sure that you are ready for the next session by reading through the strategies and the methodologies that we're going to be employing for different markets and that sort of stuff. So in its basic sense, right, as I said, this is more of the starting off point of the advanced sessions. What we try to do is we try to lay out some methodologies or strategies or ways to look at markets, and then from there you sort of like take whatever works well for you. It is very important that that does happen, because a lot of strategies or a lot of people just think that you can copy and paste whatever someone else does and you'll be able to do it as well as they do, which is not necessarily always the case, because in some instances you might not be well suited to be a short-term trader. You might be a positional swing trader, right, holding positions for a few months or a few weeks, and therefore your strong point might be there, and therefore you're focusing on short-term trading strategies or methodologies, because Anele is trading short-term strategies and is making, quote unquote, milking the market. Is milking the market, short-term trading, and therefore I want to do the same. Right now, it's better for you to sort of like find your way and see what works well for you. Okay. And then once you figure out what works well for you, then you just focus your time and attention in refining that and ensuring that whatever sessions obviously that apply to you when it comes to that particular way of trading. Because when we're looking at strategies, right, the strategies that we're going to be looking at, they aren't time horizon dependent. Okay, because the market on the smaller time frames reacts the same way as on the larger time frame. So the market will move up or down, whether it's in the daily time frame, on the monthly, on the 30 minutes, or the 5 minute, or the 1 minute time frame. So that the time frame or the time horizon that you look to sort of like end your trades or close off your positions isn't as important as the fact that the patterns will repeat themselves on the smaller time frames as well on the larger time frames. The only thing is you need to firstly learn how to identify them and then take advantage of those opportunities. Because I know there are a few people that I've met in my trading journeys that are really good technicians, which means that they can read charts, right? They can draw squiggly lines on charts, you know, the up and down arrows. And they look very impressive, right? The market is going to do this and then do that and then do that and then do that. And the market actually does do that. And when you ask them how much they made, I mean, sometimes you treat it just with silence in general. So it's also important that the technical side is accompanied by the trade or firstly the risk control side, which is how much you bet on each and every single trade position, right? And then you have to have the trading psychology side. Sorry, so the trading psychology side is basically how you look at the markets, right? We can just call it perception just to make things much simpler. Right, we'll go into depth about that in the much later stages. Right, we're just going to start off with the basics of understanding what the technical analysis entails and how the strategies actually work out. And then obviously the fourth element is the sort of like the admin work involved in trading, because in essence, trading does operate just like any other business. So you have to have sort of that continued planning about how much or what type of performance you wish to achieve, what you do on a day-to-day basis. That involves you taking a trading plan and just mapping out everything you're going to do, your targets, what strategy you're going to employ, and what is your performance metrics, what are your performance metrics, because you need to know if you're performing as well as you should be, or if you are underperforming. Therefore, if there's an issue with the actual performance, you want to know if it's the strategy that you are currently using, it's going through a drawdown phase, or alternatively, you are not executing the strategy as you should be. So, I mean, without that sort of planning, it's sort of like trading blind. You're not sure how you make money or why you make money when you do on certain days, and then this day you make money, and then the next day you lose money. And we all know that the one of the most commonly blamed reasons for that is the lack of discipline. Everyone says, I need more discipline, I need more discipline. And that might be true, but if that's the only thing that we can blame the markets on, then I mean, that would be easy to fix. But there's a lot of things, there are a few things that would need fixing, but the only way for you to find out is to be very attentive about how you trade, what you trade, and how you actually react to the day-to-day fluctuations of the market. So it's going to be very easy. We're going to plan out everything, and we're going to make sure that it's as relatable as humanly possible. We don't want to make it seem like it's a huge task. We'll break down each and every task into very small chunks, and we just focus on one or two things each and every single thing. Okay, so make sure you download the PDF from the Telegram channel, and we're just going to go through the basic tools that we're going to be employing with the first strategy. Right, I won't be going through the PDF today. If you want to do that, you can download it. I think it's the 3 Powerful Strategies for Successful Trading. That is the ebook that should be in the Telegram channel. You just download that, and then you just open it up, and you'll be able to see what we're basically talking about here. Okay. Now, firstly, what we need to understand regarding the markets is that the markets are the markets can be very predictable sometimes, and sometimes they can be confounding, to say the least. And if you want to make a consistent profit from the market, you need to have a consistent way of actually looking at markets, right? It's no use you doing one thing today and then the next day you're doing something else. That will give you inconsistent results. So what you want to do is to have a consistent, flat out way of actually looking at markets. All right, you might use a bit of discretion every now and then by saying, if the system gives you a buy signal and there is news coming out in the next, let's say, 3 or 4 hours, and you feel very bearish about that news report that's coming out, and you might use discretion there not to take the buy signal. You get it. Or you might be on the daily chart and you get a sell signal somewhere close to this support level, then you might use your discretion and say, all right, I don't think selling close to a support level would be the best thing for me to do at this point in time. So you'd use your discretion and then decide, okay, I'm going to stay out of this market until it just basically works itself out and I can see clearly where the market is going. So that's just how you look at markets. You'd like to be as systematic as humanly possible, but in essence, you're going to have to use some discretion if you're manually trading, but as little as humanly possible. So now one of the first elements or one of the first tools that we're going to be employing is obviously price action, right, or candlestick patterns. Now we go into this in the very next session, which is on Thursday, and we look at what are the basic chart patterns that provide key indicators of what the price is actually going to be, what we anticipate or what we'd like to see the market do in the next couple of days, next couple of hours, or next couple of months. Okay, now chart patterns or candlesticks patterns provide us with a lot of clues. As you guys can see, that sometimes you have long wicks or pins on one side of the candlestick, and the next day you'd have pins on either side, and the body of the candle is very slim. So all of that does really give us an idea based off what past data or historical data has been repeatedly been doing, right? So we understand that at certain levels, once something like this, let's say this type of pattern, let's just isolate this and call this a pattern. Right. Okay, let's call this an engulfing, right? A bearish engulfing pattern. So once we see this sort of bearish engulfing pattern, it does give us a hint of there could be a potential downtrend in the market, right? So a sell-off from this particular point, and we should see some downward momentum. So that therefore, we'd be more willing to sell at this level rather than to buy. Okay, so we've made an assessment based off what we've historically tested, right, back tested, and seen that when the market actually gives us this sort of candlestick pattern, along with other indicators, of course, that's not the only thing you're going to be using, then there is a very high probability of the trade actually working out. Right, so that's the first thing that we're going to be looking at now. The second thing are these lines that you see across my chart over here, which are the big figures, all right? So we'll just call them big figures or round numbers, whatever the case may be. Now, these are psychological support and resistance levels. The simplest way that I usually explain it is if you're looking at the United States dollar versus the South African rand rate, we usually have these sort of how can I put it, times where the market drops, let's say, to the rand weakens, all right? Or let's say the rand strengthens, because it's going to be USD, the rand strengthens rather, and the USD goes down to probably 12 rand, right? Now, when it gets to 12 rand, the United States dollar versus South African rand, when it gets to 12 rand for one US dollar, then psychologically, I mean, there are people who are going to decide that that is cheap in a sense, right? And therefore will start buying up at that particular point in time. That is at a retail level, which is like retail traders like you and I, and also at a institutional level, let's say your major investment firms and stuff like that. So they will also look at that in a sense that right now the rand is undervalued, and therefore at 12 rand to the dollar, we are looking to buy up, right? That also will influence the price moving higher. So that's why we use these levels. And if, let's say, for example, it pushes up to around 16 rand to the dollar, then you know that what you expect is you sort of like have that anticipation or that sort of frame of thinking that says, I think the rand is a bit undervalued now, and therefore USD should drop a little. Okay, and then that would repeat itself on a consistent basis. Right? Sometimes it's not 12 Rand, sometimes it might extend down lower to 11 Rand. Okay, but we have this sort of idea, even us talking right now, we have this sort of idea how much the United States dollar is worth versus the South African rand. Because if I just popped in today, you might not have looked at the news. If I popped in today and said, okay, the USD is 10 Rand, so it's 10 Rand for $1, you'd actually be shocked. You'd be like, that is extremely low. But if I told you it is 14 Rand 50, or if it's 14 Rand, or if it's 13 Rand 58, then you'll be like, okay, that sounds reasonable. So that is where the whole concept actually comes from. And that is why we sort of like use these big figures, these round numbers over here, sort of like give us an idea of where these major institutional plays could potentially come in. So sometimes you might see market just boom, rebound right off a round number. Sometimes you might see it extend a bit, just about, let's say, 10 to 25 pips above or below that level, right? And then pull away. It really just depends on what the actual intention is. Now, our focus is to spot the areas where there is the highest probability of the market going in our direction. Right. So that's what we're looking for, high probability trade setups. That is your job from now on. Okay, there is nothing else. You're not trying to predict the market. You're not trying to push the market this way or that way. You're not trying to do anything fancy. Just look for high probability trade setups on each and every single day, and then take those trades. That's it. Okay. Okay, guys. All right. So now that is the second part of it. Now, the third is moving averages. All right. So I'm pretty certain that most of you guys should be familiar with moving averages. If not, there is a video on that on the channel. So you can just go through that and just familiarize yourself with the moving averages. However, we are going to go over them. We are going to go over them and which ones we use for which particular strategy. Okay. Now, moving averages are important because what they provide, first and foremost, is a way of sort of like getting an idea of what the market actually is, which direction the market is going. Because at a glance, you can actually go back, let's say on the daily time frame, right? So this is the 200 moving average exponential. And just by looking at the moving average itself, right? The moving average is above, firmly above the price action. So therefore, this is a downward trend. You can see that just at a glance. Okay. If we go on to, let's say, the 30-minute, okay, and let's just choose something small. I just want to get an example of uptrend. Okay, don't seem to be getting that. Right, let's just look at another chart rather. Okay, so let's say, boom, we're looking at this on the M30, but we see that we have the moving averages firmly below the actual price, and the price action is hovering just above where the moving averages are. So just by at a glance, we can see that this is a uptrend. It might be a short-term uptrend, it might be a long-term uptrend, depending on which time frame you're looking at it, but it just gives us a very simplified way of looking at it. So, right. Now, another use for the moving averages is as support and resistance levels. Okay. Now, also what we need to know and understand, which we're going to go through in the next session as well, it's also on the PDF. We are not trading by ourselves. Okay. Now, as retail traders, we like to think that we are the center of the world, but we're really not. And the foreign exchange market is dominated by large institutions, also looking to make a profit from these markets on a day-to-day basis. So their way of trading is actually different from the way we trade, and that is largely influenced by the fact that they have much more capital and money to play around with, as opposed to the average retail trader who will have probably around $100 or 200 US dollars, which is not even a drop in the ocean when you think of like 5.6 or 5.7 trillion USD that's floating around the FX market on a daily basis. But in a sense, then what these sort of methodologies that they can employ are actually very limited, because if I want to buy one standard lot right now on the euro dollar, okay, or on the euro yen, then I can just click buy USD euro JPY and I'm gonna get a fill, right? And if it goes in my direction, then I make money. Now, if a very large institution tries to do the same thing, they would have to go, let's say, 10,000 lots, for example, right? Just using that as an example, because they're managing much larger funds, right? The liquidity or the people who are willing to sell whatever they're buying at that particular level might not be available. Okay, so in essence, as a retail trader, you do have somewhat of an advantage, because when you're seeking liquidity, you can always find liquidity. But as a very large institution, it's very difficult for them to find that sort of liquidity, because they need to, because they're trading with smaller guys, right, as opposed to themselves, right? So they're trading against smaller guys as opposed to themselves, and therefore it's very difficult for them to get fills on these very large orders that they actually execute. Okay, so the moving average actually helps us to look at support and resistance levels, where a lot of these major institutions might be using algorithms to trade. Right? Now, remember, if you're talking, let's say, pension funds, for example, right? So if you're talking pension funds and algo funds, right? I'll just call algo funds that use algorithms and stuff like that to trade, which is basically like robots. They'll have a very systematic way of looking at the markets and be like, okay, if the market breaks below the 200 moving averages, 200 moving average, and closes below it with a candle, then I am looking to sell, right? So then the automated system will sell as soon as it drops below this moving average, right? This is the 800 rather. As soon as it drops below that 800 moving average and closes below it, right? Now, which is why sometimes then once this closes, you might see a push to the upside. Okay, I'll still explain this. Boom. And I'm pretty sure some of the guys who are more experienced understand what this basically is. Okay, so also, as these moving averages are support and resistance levels, they are used basically as breakouts. Okay, so just like you would a normal support, just trying to move back, guys. But as you normally would use a support and resistance level as a breakout, for example, you wait for the market to break below, let's say, this 120.50 level. Okay, so the market bounces off, boom, and then comes back, boom, boom, finally breaks below it, comes back, retests, and then you anticipate a drop. Okay, so likewise, you'd expect more or less the same thing from this. All right, so you get this push, and you can see that this acted as a resistance in that it pushed above the 800 moving average and then pulled back in to close below. All right, it closed below and it moved down. Now that, as I said, there is a reason for that happening. We'll go into depth about it once we get to that section, but it gives us some really reliable signals when it comes to understanding support and resistance in terms of moving average. Okay. Now, the last element that or the last tool that we're going to be using is called the Fibonacci, right? So the Fibonacci, right? So the Fibonacci retracement tool is a number sequence, right? So it's a basic number sequence that measures these retracements. Okay, so retracement is basically, let's say the market pushes up 100 pips and pulls back in 50 pips. That is a 50% Fibonacci retracement. Right, we'll go into depth about how Fibonacci got introduced into trading and how to look at the numbers and what are the targets and where are the most optimum areas where we'd like to see the retracement coming. But it's just important now to understand that a retracement is used, obviously, we're going to be looking at trending markets, right? Markets that are going in one particular direction, because that's usually where you get more bang for your buck. And as those markets move in that one direction, they're not going to go up vertically. It's not just going to go straight up. They'll push, let's say, 200 pips and then pull back, let's say, 50 or 20 pips and then continue on the upward trend. So that's what we're looking for, those opportunities to actually get into the market once it started moving. Okay. All right, guys. Are you good? Okay, any questions, guys? Okay, I think we just have a few minutes left in this session, right? So I'll just open it up for some questions. Now, what you guys should be doing now is just downloading that ebook. Make sure you just go through it. Now, a lot of guys just like to go through everything all at the same time, and then obviously that can be very confusing, or sometimes it can be very irritating because I'm just going to be I'm going at things at a certain pace, and they're just way ahead of everyone, which is not going to be very helpful. So we'll just take things very slow. We'll just look at one strategy at a time. Right? There's 3 strategies. We'll look at one strategy at a time. If you want to go through to the second or third one, be my guest. Okay? But it's pointless because we're not going to cover it anytime soon. We're just going to focus on this particular one that we have right in front of us. And then the next couple of sessions after that, then we'll start looking at all these other strategies. Okay. All right, so just make sure you've downloaded that. We'll be uploading this session for you guys. So I'm just going to be preparing for the beginners tomorrow, the guys who are just fresh out, and then we'll just start them off. We're just going to be going through the platform, right, and all these other. Okay, we're just going to be going through the platform, what candlesticks are, what is the pip, what is the FX market. So if those are the things that you feel like you need right now at this point in time, then it would be beneficial for you to join those sessions, right? So make sure 7 p.m., right? I'll send through the code at about 6:55 p.m. Hopefully there won't be any load shedding tomorrow around that time. If there is, then I will send out a message to reschedule the time. So we're either going to do it a bit earlier, right? Preferably, because if we can't do it at 7, if there's load shedding at 7, it's usually at about 2 hours. So 9 p.m. is a bit late. So we'd probably have to push it back about 30 minutes or 45 minutes before the usual start time. All right? But we'll certainly work a way around it. Now, if there aren't any questions, guys, thank you very much for coming through. We'll be seeing the beginners tomorrow at our session 7 p.m. Make sure you got the PDFs as well. Module 1 through to 4, we're going to be going through that. So you guys can get started. All right. So thank you very much, guys. Enjoy the rest of your evening. Cheers.